Hello, beautiful people, and welcome to this week's edition of the ITU Forex class. In today's class, we're going to be talking about how to trade breakouts effectively. So, we've been talking about market structure, price action, and all of those things in the previous classes, okay? Today's class is actually going to build upon what we've learned in the past and then help you to improve how you time your trade entries, okay? So, basically, trade breakouts are what you have on a price chart, the phenomenon that occurs on a price chart when price eventually gathers enough momentum to break through a level which it previously couldn't break through. So for example, if you have a resistance area or resistance level on a price chart and which price previously couldn't break above, eventually if price gathers enough momentum and comes to break beyond that level, that is going to be considered as a breakout to the upside, okay? Because it's a resistance level that is being broken through. While on the flip side, when price breaks through below a level of support which it couldn't previously break below, that is also a breakout, but that's a breakout to the downside, okay? So let's quickly look at an example in an illustration before we move on to the live charts to actually identify these levels, and then we'll proceed to learn how to trade with them effectively, okay? So first things first, what does a breakout look like? Now, if you remember from our class on market structure, you'd know that there are three phases that the market can exist in. The first is the trending market phase, and when the trending market phase is broken down, you'd have an uptrending market and a downtrending market, okay? Now, apart from the trending market phase, we have two other market phases, okay? The second is the consolidating market phase, and the third is the ranging market phase. Now, we're going to be focusing on the trending market phase here because breakouts are more effective, or breakouts that occur during trending market conditions are the ones which are going to give you the best bang for your buck. Because if price is in a range or if price is consolidating, if it breaks out of a resistance of breaks out of a resistance or a support area, that breakout is not going to have enough momentum behind it. So if you take trades based on those type of breakouts, yes, you might be right one or two times, but overall, you're not going to get the type of move that will give you high risk to reward ratios and make those breakouts on the grand scheme of things, make it profitable for you to trade. And that's why the first thing you need to know to be able to trade breakouts effectively is that you only want to identify and trade breakouts which occur when the market is trending. Okay? So, with that out of the way, let's say we're trading a breakout during an uptrending market condition. What is that going to look like? Now, what is the anatomy of a market structure is the first question we're even supposed to be asking first before trading breakouts during a trending market. So first things first, you know that when the market is in an uptrend, it is supposed to be making higher highs and higher lows. Higher highs, higher lows, higher highs, higher lows. Okay? This is the anatomy of a healthy uptrending market. The reason why I say this is the anatomy of a healthy uptrending market is that when the market is in an uptrend, what we usually want to see is for price to be forming higher highs and higher lows. So this first point we have here, or let's start from here, okay? The origin point where this move began. This would consider it as a high because price came from somewhere around here and it couldn't break above this level. So since this is our starting point, let's just call it a high. And this area, which price came all the way down to, let's call it our low, represented by the letter L, okay? Now, when price came to this low area, it couldn't move down any further. And because of this, price eventually bounced from this support area or support zone, and then it moved all the way up here. Now, when it moved here, you can see that when you compare this high, which was formed here, this high level, when you compare it to the previous high, you see that it is way higher than the previous high. And this is the reason why we will call this HH, which is our higher high. Well, this low, which after price came into this high, it couldn't break any further. It pulled back to form this low. Now, this low, when you compare it to this previous low, is higher than actually this low is higher than this previous low. And so we're going to call this low our HL, which is our higher low. Okay? higher highs, higher lows. Remember I told you during an uptrending market, the anatomy for a healthy uptrending market is higher highs, the formation of higher highs and higher lows. Okay, now I want you to come back to this area on the chart. Okay, this was our origin point and this was our high where we started labeling our charts from. If I draw an imaginary line here, this is assuming that this was supposed to be a straight line, so pardon my drawing here, please. You can see that price, for whatever reason, okay, this previous resistance, this area where price found resistance at, and then it pulled back to form this low. When price retested this area, it didn't find the same resistance which prevents it from moving any further up here. But rather what it did was it broke above this area to form this brand new higher high. Okay? So what does this tell us? This is telling us that this area that was proving to be a resistance area in the past, price was actually able to break above it. So this, technically speaking, this is a breakout. This is a breakout. This is exactly what a breakout looks like. And with that in mind, if you were to look at this area on the chart again, let's do the same thing we did here. Draw our imaginary line here. You would see that this area was also a resistance area in the past. Why do I say it's a resistance area? It's because when price came from all the way down here to all the way up here, it found it very difficult to continue moving up and up and up. It failed for some time here. Okay, it found it difficult to continue moving up and it paused for a little bit. Then it pulled back. At the time when it pulled back, there probably wasn't enough momentum to keep pushing prices higher. And that was why we had a temporary stall or a reversal, temporary reversal in the trend when price came to this particular area, okay, this area right here. But then, because the market overall, the momentum to the upside was much higher than the momentum to the downside, you can see that this pullback or this temporary pause was just temporary, like the word signifies here, okay? So eventually, price gathered enough momentum after pulling back to come back to this area and break above it. This is our second breakout trade, okay? This is our second breakout trade because we had the first breakout here when price came to this resistance and it couldn't break, it pulled back because it couldn't break any higher. But then when it gathered enough momentum, it came and it broke through this resistance area. The same thing happened here also, okay? Now, what does this have to do with anything? Well, what I'm trying to make you understand is that when you understand market structure and you understand that market structures for a bullish trend, for example, is the formation of, is characterized by the formation of higher highs and higher lows. When you have established that a particular trading instrument is trading to the upside, or the direction of the trend for that particular instrument is in the upside, what you would need to do to trade breakouts is for you to identify the levels where price was finding it difficult to break above in that particular market condition. So in this case, when price came to this type of areas and it couldn't break above these areas, you would have placed a buy stop pending order so that you would get into the market with a buy trade when price is able to break above this resistance, okay? This resistance right here. And why is that so? It's because we're in let's say we've already been able to identify that we are in an uptrending market using maybe moving averages or market structure or any of the market techniques that you use to identify the direction of the trend. After you've been able to identify the direction of the trend, then you've identified that, okay, price came here and it found resistance. It couldn't break any further. So for whatever reason, the logic here is that if price was to retest this area, since we are in an uptrending market and price previously couldn't break above this area, so if price was to, for whatever reason, come to this area again, but then instead of finding it difficult to, break above the area, it clearly breaks above this area. The idea is that the probability that price is going to continue moving up since the market is in an uptrend is much higher than the probability that price is going to move down. And that is the logic, that is the reasoning behind taking breakout trades. So when you identify the direction of the trend and you spot areas where price temporarily stalled or resistance areas where price couldn't move past, when you identify those areas, you just place your buy stop pending order in the case of an uptrending market, place your stop loss. Preferably, if you want to, remember I always tell you that there are two ways you can approach this. If you're an aggressive trader, then your stop losses are going to be tighter. But what is going to compensate for that type of tight stop losses is when your stop losses are very tight, because they are very tight, it's going to be easier for price to reach your stop losses. And as a result of this, this is going to negatively affect your win rate. So you're going to get stopped out more often. But if you play your cards well, and let's say you are trading with a minimum of something like a 1:3 risk to reward ratio, meaning every time you're risking 1% of your trading account's capital, for example, you're aiming to make 3 times what you're risking, which is going to be like 3%, for example. Okay, that's your minimum risk to reward ratio. In this case, even if you have a very low win rate, because on average your profits from your winning trades are like 3 times what you lose on average from your losing trades, that's more than enough for you to make good money with. Because let's do the math here. Let's say you take 100 trades using this approach. And then out of those 100 trades, your win rate, let's just say for this particular example, your win rate is 30%. Meaning out of those 100 trades that you took, you won only 30 trades, winning trades here, and you lost 70 trades, losing trades. So in this case, since you were always risking 1% of your account's capital per trade, this would mean that your gross loss was minus 70%. Okay? What about your gross profit? Your gross profit is going to be those 30 trades that you won. Each one of them must have brought in a profit of 3% for you. That's the minimum profit they would have brought in for you. So when you multiply 30 by 3, which is 3%, which each winning trade brought as a profit for you, you would end up with a gross profit of plus 90%. Now, when you subtract your gross loss from your gross profit, you're going to end up with a net profit of 20%. So even though your win rate is only 30% in this example, it's very, very low, like 30%, right? You still ended up making profits, okay? Now, let's come back to what we were talking about with regards to the breakout. If you want to trade using the aggressive approach, then your stop losses are going to be very tight. Meaning, if, for example, you identify that, okay, price is in an uptrend, and then when price came to this level, it couldn't break above this level, but then when it pulled back, you started noticing the formation of hammer candlesticks in and around here. Remember, we talked about candlesticks in the last week's class, okay? So let's say you started spotting price rejection candlesticks, like hammer candlesticks, and then you start seeing bullish engulfing candlesticks and all of that, which is telling you that price is probably finding it very difficult to continue moving to the downside, and it might just continue moving to the upside. Then that's a good time for you to place your buy stop pending order, and then you place your stop loss, your tight stop loss, your aggressive stop loss, right below the level where price started rejecting or getting rejected at. And so if this was the distance that you're going to, let's say this distance was like 20 pips, okay? Then in this case, if you're trading with a 1:3 risk to reward ratio, because your stop loss is 20 pips, your profit target will be something like 60 pips, okay? So this is using the aggressive approach. Remember, I told you that there are pros and cons in trading. There's nothing that is, 100%. So if you're trading with the aggressive approach, yes, you might get stopped out more because your stop loss is very, very close. And so price might just whipsaw you or, whipsaw you out of the markets with the trade. But if you're trading with the conservative approach, using the conservative approach, you're most likely going to be using your previous lower low, okay? Lower high. Okay, so instead of using this higher low that you have here, you would be using the one that has been established. The logic is that if price is in an uptrend, remember, it's going to be forming higher highs and higher lows. And so if price is truly in a healthy uptrend, it would have no reason whatsoever to come all the way back down to the low that it had left, far, far away from there, you understand? So if this particular trade setup you identified, you placed your buy stop pending order, anticipating that price is going to break above this level, and then you're a conservative trader, so you place your stop loss way down here. By virtue of your stop loss being way down here, your pips that you're going to be risking per trade is going to be much larger. So if somebody that is trading the aggressive technique is using only maybe on average 20 pips per trade setup, It's going to depend on the setup, the amount of pips that you're going to be risking. That's why you're going to be using position sizing to get the exact percentage that you want to be risking per trade properly calculated. Okay, so if somebody is using the conservative method, this particular trade he might need to risk something like 60 pips, okay, in order to risk exactly 1% of his account capital on this particular trade setup. Now, the downside to using the conservative approach is that since your stop loss is going to be very far like this, if you wanted to go for the same 1:3 risk to reward ratio that somebody who is using the aggressive technique is using, your trade needs to move like 180 pips in your favor before you can make a profit from that trade. And so it's going to be, it's not every trade that is going to move that much for you, especially if you're trading currency pairs that are not as volatile. Okay, so in this case, because this is the negative side of using the conservative approach, and what's the positive? The positive is that because your stop loss is very, very far away from your trade entry, because by this example I showed you, it's going to be something like 60 pips. On this is just an example. This would mean that it's going to be much more difficult for price to hit your stop loss. And so your win rate is going to be a little bit higher when you compare it to somebody who is using the aggressive technique. But that does not mean that you are going to make more profits than the person using the aggressive technique, because he is going for a much larger risk reward ratio. So if you have something like a 45% win rate or a 50% win rate, and the person using the aggressive technique has like a 40% win rate, because his profits are much bigger on average, he might still end up making more profits than you, even though you have a lower win rate. You just need to, like I told you, anything in trading is not 100%. So you just need to know what you're comfortable with and then using that to trade effectively, okay? So let's look at a couple of examples on the live charts of how breakouts can be used to identify low risk, high probability trade setups. Okay, so what you're seeing on the charts right now is the 3 time frames for the strategy that I'm using, okay? So the way this strategy works is, I've talked about this strategy not once, not twice, quite a lot of times, okay, throughout the ITU Forex classes. So the way the strategy works is that it uses 3 time frames, okay? There's the higher time frame, the medium time frame, and the lower time frame. The higher time frame, the job of the higher time frame is to identify the direction of the trend. Remember, in the illustration I just showed you, I told you that before you can be able to trade breakouts, you want to know what the direction of the trend is, because if you don't know what the direction of the trend is, then you're not going to be able to align yourself with the low risk, high probability setup, which is much likely to play out in your favor in the markets. Okay, so for this particular one, the way the strategy works is I use these 3 moving averages to identify the direction of the trend. Okay, so if price is trading above these moving averages on the daily time frame, for me, the direction of the trend is bullish, meaning the direction of the trend is up, and I'm only going to be looking for up bullish long trades on the lower time frames. Okay, anything that is showing me that I should sell, if moving averages, if price is above the moving averages on the daily time frame, I'm not interested. I'm only going to be aligning myself with what the market is, the direction of the trend on the higher time frames. Okay, now if you take a close look at this chart, you'll notice that price currently is trading below these moving averages. And so by virtue of the rules of my trading strategy, my trend trading strategy, I'm only going to be looking for sell trade setups, okay? Because the price is trading to the downside, and so the probability that price is going to continue moving down is much higher than the probability that it's going to reverse and start moving to the upside. So how do I identify my trade entries? I've just explained how to identify the direction of the trend using the moving averages, how I do it using my trading strategy, okay? So the way I do this is, after I've been able to identify the direction of the trend on the daily time frame, so if price is trading below the moving averages on the daily time frame, I'm only interested in short trades on the lower time frame. And if price is trading above the moving averages on the daily time frame, I'm only interested in going long, okay? Before I look for those trade setups on the lower time frame, which is the 1 hour time frame for this example, I will first need to confirm the direction of the trend using my medium term time frame. So if price is trading below the moving averages on the daily time frame, I also want price to be trading below the moving averages on the 4-hour time frame. So in this case, you can see that price is trading below the moving averages. In fact, for the past, let's say, past 1.5 months, price has been trading below this moving averages on the daily time frame. And so when last week came by and price was, all the way up here, and then it reversed to start trading below this moving averages here, this was my cue to start looking for low risk, high probability short trade setups in the direction of the trend on the 1-hour time frame. And how do I do that? The way I do that is, as soon as I see that price is trading below the moving averages on the 4-hour time frame and the daily time frame simultaneously, I will now wait for price to cross and close below the moving averages on the 1-hour time frame, which is exactly what happened here. And so I use these fractal indicators, these triangles that you're seeing on the chart. They are known as the fractal indicator. If you want to add them to your charts, go to Insert, go to Indicators, the indicator category, and then under Bill Williams, you're going to see fractals. This is where you add the indicator, the fractals indicator on your charts, okay? So what I use them for is to identify swing points or breakout areas on the price chart. So when a fractal forms like this, it's telling me that price tried to continue moving down, but then it couldn't continue moving down for that particular moment in time. And so it got rejected and then price started moving up. The logic for my trading strategy is that whenever a fractal forms, it's showing me that price couldn't continue moving in the direction of the trend, and then it temporarily reversed. So when this temporary reversal occurs, I would now be waiting for price to show me, okay, that it's likely going to break below this area. And why do I do that? The reason why I do that is because we're in a downtrend, remember? The daily time frame is bearish. The 4-hour time frame has confirmed the bearishness of the trend in the daily time frame. And so on the 1-hour time frame, whenever I see that price has tried to move down, but it failed moving down, and then it temporarily stalled, I'm going to place a sell stop pending order at that fractal candle's low. Because if for whatever reason, after price reversed, like it couldn't continue moving in the direction of the trend, if for whatever reason price comes all the way down here and breaks below the candle where it couldn't break any further below, if for whatever reason it does that, this is showing me that there's a likelihood that the trend might continue. And as a result of this, I want to be in the market. I want to be in that trade. Because if the trend is going to, if truly the trend is going to continue, then because the direction of the trend on the higher time frames is down, then that move is going to be a move that will be very, very, how should I put it? Very, very profitable for me to take. Low risk, high probability trade setup. So for this particular example, on the 1-hour time frame, not only do I use the moving averages, which is the same moving averages I add 60 period simple moving averages, which is the same moving averages which I added to the daily time frame and the 4-hour time frame. It is also the same moving average I added to the 1-hour time frame. But instead of just using them to identify the direction of the trend, which is what I do with the moving averages on the daily time frame, on the 4-hour time frame, on the 1-hour time frame, I use them to identify my stop loss levels. Okay? So in this case, you can see that here we've identified our entry. And then if for short trading positions, the simple moving average which was applied to prices high is going to be wherever it was when we were placing our sell stop pending order, that is where our stop loss is going to be. So for this particular trade setup, you can see that my sell stop pending order would have gone here, and then my stop loss at the time of entering this trade would have gone somewhere around here. Okay, that was my initial stop loss. And so when I placed this trade, you can see that price, even though price triggered me and it came very close to hitting like 2R profits for me, it came reversed all the way up and it almost triggered my stop loss, but it didn't. And this is where trusting the process is very, very important, because you can't just enter a trade and then because price comes very close to your stop loss, you now close the trade thinking it's not going to play out or whatever. No. You have to follow the rules of the strategy and let things play out. The reason is because whenever price comes close to your stop loss, you keep taking those losses. There are times when you're going to see trades like this, which simply means that price would come very close to your stop loss. And if you get emotional and close that trade, just look at what happened. I would have closed a trade here, which would not have even been a losing trade, because after price came all the way up here, it didn't hit my stop loss. It eventually went down in profit, almost giving me 2 times what I was risking on the trade. And so this is why it's important to, when you have found yourself a trading strategy and you've backtested that trading strategy and you've proven to yourself that that strategy has an edge over the market, when it tells you to place your stop loss and sit on your hands, don't do anything else. Because if you keep doing this, you're going to have situations where you're going to be closing trades with losses, which would be trades that you were not even supposed to close with a loss in the first place. Okay? And you're going to do this up until the time when you close trades with profits because you think you've made enough profits, only for you to see the trade going 10 times what you're even risking on the trade. So a trade that would have given you 10% profit, a single trade, if you're risking 1% of your account's capital and that trade, let's say it does 1:10, one single trade that would have given you 10% profit on your account, because you got emotional and you're feeling like, you know what, I made a profit of 2R and I've seen this before, the market can reverse against me and then go and hit my stop loss, and so I'm scared for this little profit that I have now, I'm going to take it. If you keep doing this, you're only going to be destabilizing the results of your trading strategy because you're not letting it do its job. Okay? So when your strategy tells you to place a stop loss here, place it and just do nothing. Especially if you've backtested that trading strategy and you've proven to yourself that the strategy works. Okay? So this is basically what breakout trading means. Okay? I've explained the concept for you and I've shown you using the trading strategy, which I use. I use this trading strategy up until this day. I use it to trade profitably, but like anything in the market, you can't just copy the strategy now and just go and start trading with it on a live account. The steps you need to take is first, understand the strategy fully. And then after you've fully understood the strategy, backtest that trading strategy on historical data to prove that it works. Because even though it might work for one or two currency pairs which I trade, you need to also backtest it on trading strategy, the strategy on currency pairs that you want to trade, because maybe it might not work that well for the particular strategy that you have, for the particular currency pair you have in mind. So test it with the strategy, with the currency pair you want to trade, and if it's profitable, then you'd move on to the next step of the testing phase, which is to forward test it to prove that the backtest period that you tested the strategy on was not just a fluke. So it wasn't just profitable by chance or by luck or whatever. That's why you're doing the forward testing. And after forward testing, test it live on a live account with a small amount of money, okay? Preferably on a nano account with very small amount of money that even if you were to lose, you would not lose sleep over. And so if it's profitable after back testing, forward testing, and live testing on a small account, then you would proceed to using the strategy with a bigger account and large funds or whatever the case might be. Okay, but basically this is this is the process you need to go through. Now, this might sound like a lot of work to do, and yes, it is, and that's why a lot of traders don't end up being successful in the market, is because they don't want to put in the work to do what it takes to become a consistently profitable trader. A consistently profitable trader doesn't just go and start searching for, videos of trading strategies or looking for the next gurus to give them something, the strategy they use. I can give you my strategy, but if you don't backtest it for yourself to prove to yourself that it works, then you're not going to be able to continue trading with that strategy, especially if you encounter one or two losing trades with it. Okay? And so you need to put in the work, go out there, backtest it, prove to yourself that it works. And this brings me conveniently to what I would like to introduce you with our company, okay, which is the suite of ITU bots, which are robots which are designed to trade on your behalf and help you to earn money while you're learning, okay? So if you are interested in getting a trading strategy which has already been coded, proven to work with proper risk management and everything, then reach out to us on any of the socials and we'll be more than glad to help you set everything up. We've got a suite of bots that trade all kinds of financial assets, aiming to make you profits and also managing your risk properly while it does that, okay? Again, there's nothing 100% in the market. We are just giving you the odds of winning with our suite of bots which have been tested rigorously and proven to work, okay? So if you're interested, please reach out to us on the socials, and then would be more than happy to assist you, set everything up, and get you up and running as soon as possible. Once again, thank you very much for reaching out, and thank you for this week's edition, for attending this week's edition of the IT Forex class. I look forward to seeing you guys in next week's edition, where we're going to, as usual, give you the tools, tips, and tricks which you would need to become a consistently profitable Forex trader. I look forward to seeing you guys in next week's edition. Cheers and have a good one. God bless you all.